A warm welcome to this fresh package of Energy Frontiers with me, Justina Okechukwu. Let's get started with the headline stories put together over the course of the week. Crude oil prices were set for their first weekly gains in the week after 3 straight weeks of decline, as the US dollar retreated on the back of the US Central Bank Chief Jerome Powell hinting of a slower rate hike starting this month. Traders in the market also stayed focused on 2 big events: the December 4 virtual meeting of OPEC and its alliance, including Russia, as well as the December 5 deadline set by the European Union to cap the price of Russia's oil around $60 a barrel. The Sustainable Energy Fund for Africa has approved a reimbursable grant of $1 million to New Africa Impact Limited, a renewable energy developer, to construct 2 bioenergy plants in Ghana and Sierra Leone. Both plants are expected to release 5 megawatts of electricity and 11 megawatts of heat each. The African Infrastructure Investment Managers has agreed to invest an initial equity of up to $90 million to set up a new renewable energy platform known as NOA Group Holdings Limited in order to deliver net zero energy solutions for Africa. About 1 million Egyptians are set to gain access to clean energy after AMEA Power, based in United Arab Emirates, signed a $1.1 billion deal with a group of international finance institutions looking to start the implementation of 2 projects to produce electricity with a total capacity of 1 gigawatt. The Nigerian National Petroleum Company Limited in the week announced the signing of $1.4 billion financing agreement for Northern Hydrocarbon Funding Limited, which was arranged by Standard Chartered Bank of the UK and United Bank for Africa. NNPC says the funding will facilitate its commitment to sustainably meet current energy needs and deliver energy for the future. Libya's state-owned oil company, the National Oil Corporation, has given the green light to restart the country's ethylene plant after over 8 years of suspension. The Ras Lanuf ethylene plant is the largest station for producing petrochemicals in North Africa. French development finance institution Propaco says it has invested $10 million to subscribe to a green bond arranged by Symbiotics Investments, which will improve access to renewable energy in Africa. The proceeds from the bond will be awarded to Greenlight Planet, a leading solar home system actor in sub-Saharan Africa. South Africa's energy and chemicals company Sasol said it expects earnings for the first half of the 2023 financial year to rise above 20%, lifted by a mix of factors including the higher Brent crude oil price and a relatively weaker rand to the US dollar exchange rate. The results are expected to be released next February. And that was a snapshot of your energy news headlines. Next, OPEC Plus ministers meet this weekend to decide on whether to consider a deeper haircut on oil supply. This is Energy Frontiers. Welcome back to the program. The Organization of the Petroleum Exporting Countries and its allies, including Russia, are holding an online meeting this Sunday to decide on the next phase of their production policy. Experts are unsure what the group will decide, but oil producers are expected to act while considering the possible ramifications of the Russian oil price cap by the European Union, which is due to take effect on Monday, December the 5th. On Thursday, the EU agreed to set the price cap on Russian crude oil at $60 per barrel. So I sat down to a conversation on these latest developments with Ayo Akinduite, an associate director at PwC, a leading global advisory firm. Listen here. How important is the OPEC Alliance final decisions for the year?
In view of current or recent developments in the oil price, I think it seems to be quite an important meeting, being the fact that it's the very last for the year, and more importantly, in view of some of the recent developments in the economic space, particularly with what the oil price is doing. In recent times, we've seen some volatility in the oil price, now dropping well over $100 per barrel. And also with the threats from the G7 and US of, implementing a price cap on Russian oil. So all this put together, and knowing the fact that Russia is a member of the OPEC Plus bloc, so that seems to be potentially a very important meeting in December.
Now, are you optimistic on stronger global demand as we head into the new year?
If we're to go by the GDP projection, we anticipate that the growth in 2023 globally will be slower than the growth recorded in 2022. And of course, as you know, oil price respond to bullish economic activities. And no thanks to, some of, the disruption arising from the COVID-initiated issues in China, which is resulting in slower economic activities and slower growth, by reason of the zero COVID policy of China. So if that continues into 2023, clearly that will translate to lower economic activities and lower GDP growth. The spiraling inflation effects that we're seeing all over the world, of course, we're seeing a fair share of that in Nigeria, where inflation is now over and above 20%. So that would continue to hurt the recovery efforts post-COVID, and that will then most likely have a negative impact on oil demand generally.
Now, tell me your views on plans by the G7 to place a price cap on Russian oil. What could be the wider ramifications if that cap goes into effect?
Yeah, I think it's quite an interesting development. And maybe we'll step back a bit. What exactly is this price cap? Effectively what the EU and America is basically trying to do is to compel or find a way to pressure Russia, and do things that will hurt the economy of Russia in view of the ongoing war against Ukraine. And one way to achieve that is to limit the amount of petrodollar that flows into the economy of Russia. And they're now planning to do that by enforcing some kind of discount, to the price of oil for Russia. And if that happens, I think Russia has made it clear, that for countries that implement such, discount, or price cuts, they will not be willing to make delivery to such countries. And already, from the information that we have, it seems as if a significant part of Russian oil is being sold to India and China. So not a lot of it is going into the countries that are likely to be sympathetic, to EU along this line. And potentially, if Russia goes ahead with its threat of not delivering oil, the implication then is that there will be constrained supply. And of course, the forces of supply and demands have a direct impact on price. So we may then see the price of oil spike up again. But of course, there are a couple of other factors also to be taken into account. I mentioned earlier on the fact that the global economy seems to be struggling post-COVID, so that's moderating the price. And we've seen that in the last couple of weeks, the price now ranging between 80 and $90. So that reduced price that we are seeing as a result of some of the action, relating to COVID restriction in China, reduced productivity, as a result of the low economic growth globally. So that reduction may then be reversed, by reason of not having sufficient supply. If Russian oil is taken out of the oil supply generally, and demand remains largely the same, or particularly in 2023, it's projected that there will be some marginal increase. So if that happens, then potentially we may see a spike in oil price. But having said that, anyway, there's every likelihood that even if that price cap goes on the 5th of December as planned, the impacts may be limited, particularly if the likes of China and the like of India, refuse to implement those price cap. But what may be more significant is the additional action that Europe is planning on February 5th, which is basically to say even the derivatives, over and above just crude oil, that they're just going to take some action and say, sorry, we're not going to be buying derivatives from Russia. So in summary, we see that potentially, if this price cap results in Russian oil not being available or not being delivered, then there'll be some kind of shortfall in supply on the supply side. And if demand remains the same, or we see some level of modest growth in demand by reason of the relaxation of restriction in China, then that could result in some distortion, to the oil price equilibrium, and the oil price may then spike up potentially.
And that was Ayo Akinduyite of PwC chatting to me on some of the biggest headlines around OPEC Alliance meeting and the EU price cap on Russian oil, including the wider markets. There's so much to track for you in the new week in the global world of energy, as well as Frontier Africa. And that's the package for you this week, and we thank you for watching. Remember to follow Energy Frontiers on Frontier Africa Reports website and across all our social media handles as indicated on the screen. It's goodbye from me, Justina Okechukwu, and I'll see you next time.